Hi everyone and welcome to another week ahead video. Now, can't believe we're already in August. August normally a very interesting month in terms of some seasonal patterns that we normally see in the markets. Usually a bad time for things like stocks, which by extension normally a bad time for things like the high betas like the Kiwi dollar and the Aussie dollar. Normally a good performing month for things like the bond market. So it will be very interesting to see with all of the current economic events happening, with the current economic climate, how those seasonal plays, how they play out for the month of August. For the week ahead, focus will still be on US stimulus bill discussions. We also have the RBA as well as the BOE coming up. And then, of course, virus developments will be an important key focus point, especially with other places around the world like Australia as well as Spain now starting to see a pickup and spike in cases once more. So a couple of things to focus on. Join me now to the video to see how we're preparing for this week's events and, of course, as always, how we can hopefully trade them in the upcoming week as well. Right, it's that time of the year again where a couple of traders get really nervous, and it is August, of course, and the significance of this is, historically speaking, August seasonality doesn't really play nice with a couple of instruments. A few examples is August is usually the worst performing month for the Dow Jones as well as the S&P, going back all the way to 1987. On the currency front, we have the pound also suffering during August, with the pound US dollar having fallen 8 times of the past 10. It's normally the worst performing month for the Kiwi dollar, the Aussie, also taking a beating in all but one year in the past 9. But it's not all doom and gloom. With stocks normally down in August, we normally see a better performing bond market. So things like T-notes usually do pretty well, having risen 8 of the past 10 years in August as well. So the big question then is, will market history repeat itself? Well, July and August, summer months, are known for its thin liquidity, right? We also have lower volume, so that may be something to do with it. Also, if everybody thinks something will happen, it might be self-fulfilling in a way from a behavioral finance point of view, so keep that in mind. However, in the end, only time will tell whether these seasonal patterns will indeed prove accurate once more. Now, the past week has been very interesting with a few key markets making important turns. The US dollar just got pounded in this last week, especially by the British pound, as sterling had a very unloved rally and gained ground against most of the other majors. The dollar did, however, on Friday manage to reclaim a critical support level at 93.19, but the damage is done, so to speak, in July, especially the past week, just clearly visible on the chart with that big acceleration to the downside. Multiple factors really leading to that tremendous push lower in the dollar. A few of them was the US stimulus bill worries. We had diminishing safe haven appeal, Europe's outperformance, also expectations that the Fed will do more, and of course strong month-end dollar outflows. We have had other majors as well enjoying their time in the sun, like the euro that managed to trade up all the way to 119 in the week before settling back just below 118 on Friday. Stepping away from FX markets, also saw bond markets painting a very ominous picture as bond yields plunged into historical low territory, and at the same time big tech name earnings beats coming in with Apple, Amazon, Facebook. That gave equities a little bit of a lift at the end of the week, but still very well contained within that summer box according to the market ear. Now, the one thing that we need to keep in mind is equities are moving higher while bond yields are moving historically lower. Both of these two markets can't be right. So whether when we take this back to August, what will happen? Will we see equities indeed move lower, and that'll see in a further extension to the downside in yields? Or will we see equities continue higher and eventually see bond yields catching up? Obviously, only time will tell. We do have a couple of interesting events this week that might be able to prove or disprove the August seasonals. And having a look at a few of them, we have fiscal policy, economic data, central bank meetings, and of course, virus development. Starting with fiscal policy, US lawmakers have chosen to stick to their red lines, basically failing to bring in any type of alternative to that $600 unemployment benefit, which has now expired at the end of last week, or end of this week rather. Markets took this development surprisingly well from a risk point of view, but Monday might be a different story if we don't have any type of breakthroughs from that weekend negotiations. The good news is, however, that the House has postponed summer recess until a agreement is reached, so at least there is some hope for a breakthrough. Now, in terms of the possible fiscal cliff that the US is facing in terms of this benefit, it is in everybody's best interest to find a compromise and to find one quick, so a big focus point for this week. Turning to the economic data, we have, of course, NFP will be important. Apart from that, we also have ISM, non-manufacturing and manufacturing PMI. Do remember that we usually have a couple of important preludes running up to Friday NFPs. Some of them include the ADP national employment. We also have the two employment subcomponents for the ISM manufacturing and ISM non-manufacturing or services PMIs. Even though markets are expecting a print of close to 1.5 million for NFP, those expectations can change if we see bigger than expected drops or jumps in the three preluding data points, like we mentioned, especially the ISM non-manufacturing employment subcomponent, as it does represent the biggest share of the US workforce. Markets are leaning towards another big monthly gain here, and it's important to realize that the July jobs report only includes data from mid-June to mid-July. That means that jobs lost due to the reinstated lockdown restrictions coming from after mid-July won't be included, and that's one of the key reasons why the markets are seeing upside for this release. That means even though job gains have clearly slowed, when we look at something like the recent jobless claims data and continued claims data, we'll only see that effect coming into the August NFP report. So turning to the ISM figures, they should be very interesting and, as always, a very important gauge for overall market sentiment. As a forward-looking indicator, they are important, even though they do have their limitations being diffusion indexes. But the market doesn't really care that they are diffusion indexes. What they really care about is whether the number comes in much better or much worse than expected. Also turning to central bank events, we do have two currencies in focus for in terms of the August seasonality. Both of them have seen very impressive rallies, and both of them do have central bank meetings coming up this week. Both of these two central banks have two common things that they should at least be worried about. The first one is rising virus cases, more prominent now, of course, in Australia, in that Victoria state. But numbers also starting to pick up speed in the UK, unfortunately, as well. Now, the second thing they can't be happy about right now is the strong appreciation of their currencies, especially versus the US dollar. Now, even though Governor Lowe did dismiss the Aussie dollar strength a few weeks back, the current rallies cannot be something that they're happy about. If they do shy away from jawboning their currencies, they will probably try to still paint a very dovish picture, given the state of affairs with regards to the virus. For the RBA, recent jobs as well as retail sales data was better than expected. Markets are expecting the bank will probably stick to their previous comment that the downturn has been less severe than they feared, but also expect them to lean to the dovish side given the record high numbers that we've seen in virus cases. For the BOE, majority of policymakers have painted a very bleak picture of the economic outlook, apart from, of course, Chief Economist Andy Haldane, who is still seeing a V-shaped recovery. Not really close to a V, in our opinion, at this stage, but obviously let's wait for the incoming data to see. Some investment banks are expecting an upgrade for the BOE from the prior grim outlook for growth, but expect the bank to strike an overall cautious tone. After they have increased QE in their prior meeting, the bank has time to, at this stage, just sit on the sidelines right now, which means the hopes of mentions about lowering rates or going into negative territory is probably just wishful thinking at this stage. Looking at virus developments, until recently, second wave fears have largely been a US story, with cases understandably spiraling out of control in the US. However, if we have a look at this chart from the Financial Times, we can see that virus cases are starting to show more promising signs of slowdown, new cases that is, in the US, but at the same time, Europe's numbers are starting to rise back again. Now, taking a look, at that graph, the main places of concern right now is places like Spain. We've also seen an uptick in France numbers, German numbers, as well as UK. It's looking very worrisome right now. And one of the reasons for the US dollar's recent weakness was due to the impact that the virus is having on the economy in terms of the recovery. So if Europe faces a similar second wave, as we've seen in the US also going back to strict lockdowns, even if they are lighter than the previous ones, that poses a real threat for the euro as well as the pound, not forgetting the Aussie as well, with record high numbers recorded, of course, in Victoria State. Now, turning to a possible few sentiment drivers this week, starting with hawkish ones. In terms of fiscal policy, risk assets have taken the bad news about the US fiscal cliff edge very well recently, and a breakthrough over the weekend or early next week could give US equities another shot in the arm in the week ahead, especially if unemployment benefits can be included above the current expectation of that very low $200 per week. Economic data, it's all about the V, of course. Even though seeing a real V-shaped recovery seems very, very unlikely, the market will continue to hope, and thus any big and unexpected, better than expected beat above market expectations, the maximum ones that is, for the US job numbers as well as those ISM prints, can provide a push higher for risk assets and give the US dollar a well-needed benefit lift as well. Central banks, markets are leaning towards a more dovish tilt right now from both the RBA as well as the BOE in the week ahead. So if the banks decide to focus on the positives by playing down the current virus risks, as well as deciding not to jawbone their currencies, we might see a little bit of a short-term upside for the Aussie and the pound, depending, of course, what happens to the US dollar and equities. Then turning to virus developments, the only V the market might get this year is a possible vaccine. Watch out for any pump and dump vaccine developments, as they have proven to be very, very positive catalysts for risk assets in recent weeks. Looking at some dovish ones, again, fiscal policy, failure to find common ground over the weekend in stimulus talks could start to weigh on markets going into the next week, especially with that August seasonality being a very doom and gloom picture. Subsequent failures throughout the week in terms of negotiations will start to put stress on consumers who need those payments drastically, and that will be a stress point for the markets. Then turning to economic data again, even though the job numbers will be immune to the recent lockdown reinstatements that started mid-July and afterwards, the PMIs won't go unscathed, and any bigger than expected drops below the market's minimum expectation will probably push risk assets lower and could weigh on the US dollar as well. Turning to central banks, markets aren't expecting the BOE or the RBA to jawbone their currencies this week, but given the recent appreciation, it would definitely make sense for them to do so, especially from an export point of view. The last thing you want right now, given that massive economic fallout that we've had from the coronavirus, is having your currency appreciate across the board. So any overly dovish tilts from the banks, especially about virus cases spiking, should weigh on the Aussie and the pound. So will be interesting developments, those ones. Turning to the virus, any additional jumps in cases, big jumps, and subsequent reinstatement of lockdown measures in other places around the world, like Europe, like Australia, etc., will put pressure on the relevant local currency in the short term, so definitely one to watch. Turning to the potential trading plan for the week, again, fiscal policy. For any breakthroughs or setbacks in the US fiscal stimulus bill, we could look to trade the S&P as well as the US dollar, expecting both to appreciate on positive news and both to depreciate on negative news. Virus developments, any major vaccine breakthroughs and news could be taken advantage of with risk assets like the S&P, maybe even looking for upside in something like the Aussie yen, which is normally a good proxy for overall risk sentiment. Any major negative spikes, however, in virus cases in countries should weigh on the relevant currencies. On this front, expect any major positive alleviation in US cases to actually continue benefiting the US dollar in the short term. Looking at central banks, expect any overly hawkish tilts from the RBA or the BOE to support their relevant currencies, and expect any opposite reaction from overly dovish tilts, especially jawboning the currency, to really impact the currencies to the downside, especially with those seasonal factors from a behavioral point of view also kept in mind. Looking at economic data, for any better than expected US data going above the market's maximum expectations, we would expect that to be supportive for the S&P 500 as well as the US dollar in the short term. And for any worse than expected US economic data which deviates below the market's minimum expectations, we would expect that to put pressure on the S&P as well as the US dollar. Now, given the sheer uncertainty of some of these data points with reinstatement of lockdown restrictions as well as government intervention with stimulus programs, it can skew things like economic data, especially employment data with things like the PPP, the furlough scheme, just to name a few. So we wouldn't really want to be trading into any of these upcoming events this week, but we could look to take advantage of trading opportunities after the events have taken place.